A single, obscure finance firm nearly brought down a global banking giant. The year was 2021. Credit Suisse, one of the world's most venerable financial institutions, found itself teetering on the edge, not from a rogue trader or a subprime mortgage crisis, but from its entanglement with a seemingly innocuous supply chain finance company called Greensill Capital. This wasn't just a bad investment. It was a contagion that threatened the stability of an entire banking system. Lex Greensill, the Australian founder, built his empire on a deceptively simple premise: buying invoices from suppliers at a discount, then collecting the full amount when the invoices were due. This provided immediate cash flow to businesses, an attractive proposition. He branded it supply chain finance, positioning it as a low-risk, high-reward innovation. But Greensill's model wasn't quite that simple. As the firm grew, it began to move beyond traditional, confirmed invoices. It started financing prospective receivables, future invoices that hadn't even been generated yet. This was a critical shift, transforming a relatively safe lending practice into something far more speculative. To fund these operations, Greensill packaged these receivables into funds that it then sold to institutional investors. Enter Credit Suisse. The Swiss bank became a crucial partner, establishing a series of supply chain finance funds that invested heavily in Greensill's assets. Billions flowed from Credit Suisse clients into these funds, all managed by the bank. The funds were marketed as safe, short-term investments, offering attractive returns with minimal risk. Investors, including pension funds and wealth managers, were drawn to the promise of diversification and stability, especially in a low-interest rate environment. Credit Suisse's reputation lent an air of credibility that Greensill alone couldn't command. However, questions about Greensill's underlying assets began to surface. Some of the invoices being financed were from a relatively small number of clients, concentrated in specific industries, and sometimes even involved related parties. This lack of diversification was a red flag, signaling a potential over-reliance on a few key players. One particularly prominent client was GFG Alliance, a sprawling industrial group controlled by Sanjeev Gupta. GFG was a significant borrower from Greensill, and the financing arrangements between the two companies grew increasingly complex and opaque. The lines between supplier, buyer, and financier blurred considerably. Regulators and auditors eventually started scrutinizing Greensill more closely. BaFin, Germany's financial watchdog, launched an investigation into Greensill Bank AG, Greensill's German banking subsidiary. They raised concerns about the bank's balance sheet and its ability to accurately value its assets. The turning point arrived in early March 2021. Bond insurance companies, which had provided crucial credit protection for some of Greensill's assets, began to withdraw their coverage. This was a fatal blow. Without this insurance, the Credit Suisse supply chain finance funds lost a critical layer of security. On March 1, 2021, Credit Suisse announced it was freezing its 4 supply chain finance funds, worth approximately $10 billion. The news sent shockwaves through the financial world. Investors who believed their money was in safe, liquid assets suddenly found it trapped. Just days later, on March 8, Greensill Capital filed for insolvency in the UK. The company, once lauded as an innovator, collapsed under the weight of its own complex and increasingly questionable financial structures. The ripple effects were immediate and severe. Credit Suisse found itself in an unenviable position. It had to explain to its clients how billions of dollars invested in supposedly safe funds had become embroiled in a bankruptcy. The bank immediately began the difficult process of unwinding the funds and attempting to recover client money. The bank set up a dedicated recovery unit, but the task was monumental. Many of the underlying assets were illiquid, tied up in the bankruptcy proceedings of Greensill itself, or with its struggling clients like GFG Alliance. The prospects for a full recovery were uncertain. Internally, the Greensill debacle exposed significant failings within Credit Suisse. Questions arose about the due diligence performed on Greensill, the oversight of the funds, and the bank's risk management practices. Several senior executives ultimately departed, and investigations were launched. The financial cost to Credit Suisse was staggering. While client money was primarily at risk, the bank itself incurred significant losses related to bridging loans it had extended to Greensill and other exposures. Its reputation, built over centuries, suffered an immense blow. But the Greensill scandal wasn't an isolated incident for Credit Suisse. It came hot on the heels of another major loss related to the collapse of Archegos Capital Management, a family office that defaulted on margin calls. The cumulative effect was devastating. These back-to-back failures highlighted a pattern of systemic risk management deficiencies within the bank. They pointed to a culture where aggressive pursuit of profits might have overshadowed prudent risk assessment, particularly in complex and less transparent areas of finance. For the broader financial industry, the Greensill collapse served as a stark reminder of the dangers lurking in opaque, unregulated corners of finance. Supply chain finance, once seen as a benign tool, revealed its potential for systemic risk when stretched beyond its original intent. Regulators worldwide took notice, prompting renewed calls for greater transparency and oversight in non-bank lending and shadow banking activities. The incident underscored the interconnectedness of the global financial system and how the failure of one seemingly niche firm could destabilize larger institutions. The long-term consequences for Credit Suisse were dire. The bank struggled to regain investor confidence, faced multiple legal challenges, and continued to shed business units. The Greensill saga became a significant chapter in its eventual downfall and acquisition by UBS in 2023. The story of Greensill Capital and Credit Suisse is a cautionary tale, illustrating how innovation, when unchecked by robust risk management and ethical oversight, can lead to catastrophic outcomes. It demonstrates the fragility of trust in finance and the profound impact of perceived safety turning out to be anything but. From a seemingly simple invoice financing model, a complex web of interconnected risks emerged, eventually ensnaring one of the world's oldest and most respected banks. The Greensill debacle wasn't just a failure of one company. It was a systemic shock that forever altered the landscape of global finance. Explore another tale of ambition gone wrong in our next deep dive into corporate history.